What's up? We are back with another stock analysis. Today we will be looking at Paramount Global. So they are mainly a legacy media television company. However, they've been really trying to get into streaming recently. They have Pluto TV as well as Paramount Plus. So right now the company is in a very tricky situation where they may be getting bought out, they might not be getting bought out. Deals keep popping up and then falling out, and then something comes up the next day. And it's been a very long time going through this for the company, but it's definitely a very interesting company to get into because should they be able to turn around their long-term projections, it could be huge once again. But we'll have to see. It has a very low market cap compared to where it used to be. So definitely a very interesting company to get into. But yeah, so we'll get into Paramount, go through their financials, earnings chart, as well as evaluation for the company from my own process. So if you're interested, make sure to subscribe and let's get into it. So getting into Paramount, we can see they are mostly in the entertainment industry, which I think most people kind of know about. Paramount definitely isn't the largest company, but they do have a huge footprint with the things that they do, like Nickelodeon, Paramount Plus, things like that. They make movies as well, and they're also in the streaming industry now. So some numbers to look at here. I believe this is stream video or direct to consumer subscribers, something like that. And that has been sort of steady throughout 2024. And I believe this is the 2025 estimate, and they're actually expecting to have less people, which isn't great. Also, their average revenue per user did increase throughout 2024, which is pretty good. For the Pluto TV monthly active subscribers, they have seen a sort of increase, although also it's mostly been staying right around the low 90 million area. So overall, not too much progress there across the year. They do have a few more, but overall, plus with the 2025 estimate here, it's just staying the same. So overall, nothing too crazy. Market cap at 7.6 billion, which is very low considering where this stock used to be. If we go over here to the chart and look, they used to be all the way up at, well, just wherever you look, it's way higher than it is now. At one point during the COVID crash, they were actually at this price point and bounced off of it. However, since then, they've basically just come straight back down. I think a lot of this was hype with their streaming service coming out, and with that being fairly disappointing as far as I know, it has just been in a significant downtrend since then. If we go back even farther and look, they have not seen anything lower than these levels since 2009 with the recession that happened then. So this is a good price level to be at for the company for the sake of possibly being undervalued. But at the same time, I feel like at this point, it has been so long and so low that it just doesn't seem like it's going to be too good for them. Plus, with the talks of buyouts and everything like that, it just seems like there won't be too much promise for the company, and I'm sure we'll get into some of that later as well. So target price is at $12 right now, which is about $2 higher than right now. Long-term growth rate is at 45%, which is very positive, to be fair. Looking at their growth summary, however, you can see it is just about mostly negative across the board. They do have the positive long-term sales estimates. However, that is depending on will this company last that long? And considering the 10-year estimate of their free cash flow is negative 21% per year, that is kind of crazy. Also, their dividends are apparently going to be decreasing as well, which isn't great either, especially considering it has been, I believe it's been cut a lot, because considering they're at a 1.8 dividend yield right now and their stock price has fallen so much, this should be a lot higher, you would think. So I'm assuming their dividend is a lot less than it used to be currently. And if we look, we are at 5 cents a share here. And if we zoom out to a couple of years ago, we're at 24 cents a share. So yeah, their dividend has been cut drastically. And if we just keep going through here, I'm sure we'll see when that starts to happen. And it is right here, going from 24 cents a share down to 5 cents a share. So I'm assuming this earnings report is also coming with that announcement, and that shows one of their last very significant drops in stock price. So honestly, it makes sense to do if they're struggling, but at the same time, it is a very bad sign for investors. And you could just see the continuous lack of performance compared to the market here. They have not been having a good couple of years. So now let's get into the financials and see what we're working with. So I don't really know too much of what to expect here. Let's go out to the years, see if they have 2024 yet, which they do, which is awesome. And right now, you could see their sales peaked in 2022 and since then have been declining slightly. However, this doesn't include their full year 2024. This is just the last 12 months of their September quarter. So overall, I think it doesn't look great, but at the same time, I feel like there is a lot of promise just based on the fact that their sales really haven't dropped that much. But where the problems really start is with their profitability. So their operating income was actually negative for 2023, and it did make a bit of a comeback. However, it is nowhere near where it was in 2022. And even with record sales in 2022, their profitability is essentially at where their 2017 levels were. So even still, they had a fraction of the sales then, just almost a third of the sales and 130 million more in profit. So not great there at all. Honestly, really, really bad for their operating income. And moving to the net income, you can see where there's really been a problem recently. So losing 6 billion in 2024 is not great for the company. They also had a loss in 2023 as well, and 2022 despite those record sales again. So their profitability has just completely fallen off a cliff recently. Not great. I don't know exactly what's causing it, but I'm assuming it's just because of legacy media not really being nearly as popular as it is now, and their sort of pivot towards the streaming industry very clearly has not paid off, at least not yet. Um, Also, recently they did start diluting their shares again. You could see their total shares have been increasing over the past couple years, just about since 2017. Actually, their shares have been increasing. So overall, not great. They have been ramping that up a bit more, going from 640 to 667 in the past couple of years, but overall does not look fantastic. Now let's get into the balance sheet, see what we're working with. So we will go to the quarters here because they don't have their 2024 data in just yet. But their most recent report put their assets at 46 billion, which if we see is actually coming down a lot from the past 2 years. They were at 56 billion. So 2 years coming down $10 billion in assets and having less profitability is not really good at all. Now, what you can say is that they are in a restructuring right now, and it's just to be expected. But overall, I feel like a lot of the results that they're hoping for are going to be too little, too late. Um, from what I saw from the numbers, they're really not expecting a lot of growth even in 2025. So does not look fantastic. 2.5 billion in cash. They do have 15.5 billion in long-term debt. So not fantastic there. However, one thing to actually say about that is that they have brought it down a lot from where it was in 2022 at over 17 billion. So that is a good thing, don't get me wrong, but overall I just feel like it could be better. I mean, obviously they use this much debt just to get into the situation they're in now, so overall that's not really fantastic. So debt situation is a little rough. Their cash is okay, but they don't have a ton. They can cover the short-term debt though, which is a positive. And other than that, I think it's mostly okay. However, generally when we see decreasing assets, we want to see increasing or at the very least stable profitability, especially for these kinds of restructuring companies. And since we're not seeing that, that's just a very negative thing to say about the company. It's a very negative sign for them. So next is their cash flows. And you can see their operating cash flows have been positive for the past 5 quarters. However, they are very low. And I'd imagine if we set this up to go back a little bit farther, which we can see here, they most likely used to be fairly higher. This is in 2020. And actually, they always had mixed operating cash flows. You could see some positive, some negative here. But seeing this 5 quarters of consistency is fairly good. That is a good sign. And their free cash flows are positive along with that, which is also fairly good. Investing activities have been negative. They have been purchasing a few investments in 2024, which is actually fairly surprising. And you can see they've been doing that consistently actually for the past 2 years. One thing I will say though is they did sell off a ton of their other funds section at the end of 2023, so that kind of reinforces that part about selling off their assets. I'm actually surprised we're not seeing more of that just based on how much their assets are decreasing, but it could always come from other directions as well, so it's not too surprising. In their financing activities, we could see no change in their stock at all over the past 2 years. So they aren't diluting anymore based on this. Their dividends have been steadily decreasing, which we did see. Their last quarter was actually their lowest ever in the past most likely 2+ years. But one other thing to say is that 5 quarters of positive free cash flow after 4 quarters of negative is fairly solid. That is good, but I feel like it's just not enough to really motivate investors. And one thing to really say about that is when we get into the ratio analysis here, you'll really see why, because their profitability has just completely fallen off a cliff. So even just looking at 2023, they're so far below their 5-year averages. SGA is higher, but let's get into the quarters either way and take a look at that. So starting off, gross margin at 29.29, fairly lower than we saw in 2022. SGA to sales is at 23 and a third, a little bit higher. If we go back a little bit farther, you could see it is significantly higher than 2019, 2020. So not fantastic. Net margin has been aggressively increasing in negativity over the past 2 quarters, especially seeing negative 20% in the September quarter. That is not great. That's actually very bad. So not good there. ROA, ROE, same things, just increasingly negative over the past 2 quarters. So overall does not look fantastic. And one other thing is that their debt to equity is at 93%, which is on the higher end of ones we've seen. Their total debt is at 94, just about 94 and a half. So overall, these numbers are not great. They're compared to the last probably 10, 15 companies we've done. This is definitely one of the highest. And it's only been increasing in the past 2 years. They were at 77, which is considered a fairly healthier level. And I just doubt we'll be seeing this come down anytime soon. So overall, does not look fantastic there as well. So now let's see if we can get into some earnings, which earlier when I tried to load this, it didn't, but now it seems like it will. So going into the metrics, let's see what we can find. So TV media missed estimates slightly. Advertising came in a little bit above, actually. Affiliates came in slightly below, but basically in line. Licensing came in about 60 million below estimates. Direct to consumer met estimates, which is fairly good. Filmed entertainment came in over 100 million below. And then other than that, it looks like OIBDA, operating income, came in slightly below estimates. Direct to consumer actually beat significantly. They were expecting a fairly large loss and they ended up with an operating profit, which is fairly good. And also filmed entertainment came in above estimates. However, if you look specifically at this is a 3% operating income profit for their filmed entertainment. That is, or 3 million, I should say. That is off of 590 million in revenue, which is horrible. That is so bad. That's not even 1% operating profit, not even net profit. So overall, that is terrible. Free cash flow did come in significantly above, which is good. And their Paramount Plus subscribers grew at a faster rate than expected as well, which is another fairly solid positive for the company. Now, saying all that, I would say the most important things here are one, this filmed entertainment margin is just terrible. That's less than 1% of a operating margin. The Paramount Plus subscribers, though, growing at 1.7 million more than estimates is pretty good. That's actually really good. So I didn't even know they had this many subscribers, honestly. That's a fairly impressive number for a streaming service. But overall, we're just not seeing it in the numbers. So I think it's just a matter of when will that start paying off more. And the thing with that is if they increase prices in order to improve those margins, they're going to be losing millions of subscribers. So overall, it's a really tough situation for them. But we did see a lot of beats in here. Not there, but We did see some overall, but I think this is still mostly negative, especially with those operating incomes not being great. So overall, that is all I have for the earnings there. Now let's get into a valuation for Paramount. So to do that, we look at their competitors based on their PE ratios. And once this loads up for me here, I'll show you what we do. So now that it actually loaded up for me, we could see that the average is 18.65 and the median is 13.92. But that gives a valuation. So this does not work very well when the EPS is negative, unfortunately. But that gives a valuation of negative $133. So does not work too well when you have a negative PE such as Paramount, where they are actively losing money. But let's look and see if we could find some estimates for their EPS. So, looking in here, we can see their estimate for 2024, the fiscal year is at 1.8 EPS. So, that is what I'm going to go off here. And if we just put that in at 1.8, we get a valuation of right around $29, which still, I mean, compared to their competitors that we saw here, it does make sense. But at the same time, I just feel like the company's price is more focused on what they're going to be declining in, not so much their current PE ratio. So it does make sense with the valuation here, but I think there's a lot of other factors. So according to this, based on their competitors, they are significantly undervalued. So that is something to consider. But moving forward from that, let's take one last look at the chart just to highlight, which I did go through this earlier, but just to highlight really how severe their fall has been. So they saw highs in 2014 and 2017. And also, following the market run up from the COVID crash, they saw a massive all time high of just about $100 a share. But since then, they have just been enormously in a downtrend. So, and actually, you could see the trend completely driving through both of their large price fluctuations. So they saw a drop from COVID, and the trend almost perfectly continues through either way. So despite the volatility, they have strengthened their downtrend basically even more by going through this, and just does not look fantastic long term. That's all I got for Paramount today. So thank you for watching. If you enjoyed, make sure to subscribe. I do these videos basically every day. So yeah, I'll see everybody in the next video. Thanks for watching.